Hello and welcome to a brand new episode of Smart Money. Now, in the recent past, we've seen a significant uptick in investor interest in gold exchange traded funds, or ETFs as we call it. In the month of August alone, gold ETFs have witnessed the highest inflows in the last 16 months. The question we're asking today, is it time now to invest in the yellow metal? As we know, gold ETFs function as electronic representations of physical gold stored electronically in a demat account. Now, these ETFs are listed on the stock exchanges, providing real-time price updates. The biggest benefits of gold ETFs are liquidity, there's no exit load, diversification in your portfolio, and easy trading. Today, Ghazal Jain, Fund Manager, Alternative Investment at Quantum AMC, joins us now to talk more about that. Ghazal, thanks a lot for joining us. I want to start with, just to set the tone, right, of the interview. July and August were big months in terms of gold ETF investments. What is the outlook and what is the reason for which this investments are happening?
Inflows into the gold ETF category over the last year or so have been subdued, and that was mostly because the US Federal Reserve had embarked on a monetary policy tightening, which had really reduced interest in gold for investors. But over the last few months, like you mentioned, we have seen some steady inflows, and that is despite domestic equity markets being so robust. I think it's very prudent of investors because while the domestic growth story looks promising and the domestic macros are supportive of growth, domestic equity markets are not immune to external economic shocks. I mean, there's so much uncertainty related to growth and inflation globally. So I think investors coming into gold at this stage is very prudent. And looking ahead, I would say that now we are approaching the end to the monetary policy tightening by the Fed, and that has kind of really improved the prospects for gold going forward, and hence we think this momentum in gold ETF inflows that we've been seeing, that should continue for the rest of the year.
Okay, so let's talk about a couple of things, right? Whether it's the US Treasury yields and the US dollar, both of which are the nemesis of gold, right? Now, these are on the rise. So we've seen the dollar index as well stay well above that 105 mark. How is gold reacting to this? And as an investor, how do you, look at these parameters to assess which way gold prices are headed?
So usually US Treasury yields, they see an uptick when there is either an uptick in inflation expectations in the US, or there is an interest rate hike by the Federal Reserve. Of late, that is not what is really driving US Treasury yields, because that is usually bearish for gold. But in the recent past, this uptick in US Treasury yields is a lot to do with the fiscal situation in the US. With interest rates at such elevated levels, and US government elections coming up next year, and the spending programs of the Biden administration, there is a sense in the markets that the supply of US government debt is going to going forward exceed the demand. And if we talk about the demand, what's really impacting it? The US Federal Reserve is one of the largest buyers of US government debt. And as we know, they have been unwinding their balance sheet for the last year and a half. So that sort of demand has, moved out of the market. Also, external buyers like China and Saudi Arabia, I think in their agenda towards de-dollarization or reducing their reliance on the dollar, they have also been reducing their US Treasury holdings. So we have this very unique situation where US government debt supply, is expected to be higher than the demand, and that has been putting like a downward pressure on US Treasury bond prices and an upward pressure on US yields, and that is not exactly bearish for gold. In fact, it is supportive of gold investment because it shows that markets are concerned about the unsustainability of US debt levels, and that should actually divert flows into havens like gold.
So I have a counter argument to that. Sure. The expectations from the Fed Reserve's September 20th meet is that there would be perhaps maybe a pause, and there could, or maybe a small rate hike, but there could also be an indication of the end of the tightening cycle, right? If that comes through, then from there on, risky assets like equities may sort of surge. In that context, don't you think safe haven like gold may move to the back burner?
Sure. So, in the recent months, there has been this Fed pivot narrative that has come into the markets. But if you look at the data, US economy has been showing resilience. US labor markets have been showing resilience. And on the other hand, core inflation numbers in the US have been looking sticky. So we've been seeing that the Fed has actually been pushing back hard against that narrative. They have been giving out really hawkish comments. And so the markets are expecting a status quo or a pause from the Fed in September. But if you see, they have pushed back interest rate cuts to about June of next year. So whether the Fed can increase more interest rates higher than these levels, time will tell whether the US economy can digest more of that. But as far as the data is shaping up, we've seen US inflation in July and August kind of moderate, and we also expect the Fed to do nothing in September.
Pause this time.
Yes, and that should be good for gold. For risk assets, the worry is, of course, the Fed pausing is a positive, but the Fed pausing could also, reflect that they are seeing some weakness in on the growth front. Yeah, which is kind of leading to that, and that would again be positive for gold.
But in any case, I guess gold is always a great diversification strategy, right? I mean, it's always good to have some amount of gold in your portfolio, and as we know, whether it's sovereign gold bonds, gold ETFs, it's a great way to approach it. Another angle that we're looking at is rising energy prices, right? Does it complicate the global inflation situation? And if yes, because crude as we speak is at $94 a barrel. If that happens, then what is the prognosis on gold?
So, rising crude prices are definitely a cause for concern, because if you see the moderation in US inflation that we've seen over the last few months has also a lot to do with supply pressures easing, that is commodity prices coming down, because core inflation numbers, which do not include fuel prices, have been sticky. And also what has been helping US inflation is, the favorable base effects. US inflation peaked in June, July of last year, and that, has helped year-on-year inflation numbers look softer over the last few months. Whether or not, that will sustain is a question mark, because we'll see these base effects moving out. And like you pointed out, yes, rising energy prices will definitely complicate that situation and, make this inflation situation a little trickier for the Fed. And I think that is why there is this expectation in the market that we can see above average inflation, for the foreseeable future, which is, bullish for gold.
Okay, just for someone who perhaps has never had any exposure to gold and is building their corpus, right? Let's try and understand before we head into a break. There are gold ETFs and there are sovereign gold bonds. There's, of course, physical gold as well, but we are not proponents of that because of just the clunky nature of the investment, safety, security, all of that. So between gold ETFs and sovereign gold bonds, and we've had this discussion in the past, where do your preferences lie? I mean, is sovereign gold bonds a better option? And, what is the key difference?
So both, I think, sovereign gold bonds and ETFs definitely score above physical gold, like you said, and both are ideal for long-term investment. But there are a few nuances. Sovereign gold bonds, pay an annual interest and are tax efficient, which has been really, getting them a lot of attention. But on the other hand, gold ETFs also have their set of benefits. The number one being that, gold ETFs are physically backed by 24-karat physical gold, and for some, that is kind of important, and that's justified.
It's
because
like a safety net also.
Right, because gold has always been seen as an asset that is no one's liability,
Yes.
And by shifting that liability to the government, you're kind of changing the nature of gold. So we are seeing, a lot of investors still prefer ETFs over sovereign gold bonds because of that physical backing. And another thing, I think, that where, gold ETFs score above sovereign gold bonds is from the portfolio perspective. So because sovereign gold bonds come with a lock-in period, and those tax benefits only kick in if you hold them till maturity.
There's an 8-year lock-in, right?
Yes, there's an 8-year lock-in, and those tax benefits will only kick in if you hold them till the end, which means the secondary market liquidity is kind of limited. So if, for example, gold prices move up and you want to rebalance your portfolio by trimming your gold holdings, you're not going to be able to do that. If you do that, if you sell your sovereign gold bonds on the secondary market, you might be just, selling them at a discount, which is price inefficient and could eat into your returns, partly or even entirely offsetting that interest payout that the bond was giving.
Absolutely.
And on the other hand, gold ETFs, exchange traded, like you said, extremely liquid, trading very close to market prices. So
there's no exit load as well.
No exit load at all. So you can be assured that from a portfolio perspective, the liquidity that it gets, the price efficiency that it gets, gold ETFs, can be a better option.
It basically just trades like how you would trade a mutual fund, right?
Right.
And I mean, for someone who perhaps has no exposure, how do you buy it in the number of units? I mean, if you can just explain to us.
Sure. So gold ETF units, they trade on the exchange like shares.
Okay.
So you can buy even 1 unit of the gold ETF, and 1 unit is approximately equal to 0.01 grams of gold, which in today's prices is just 60 rupees. So for just 60 rupees, you can start building your exposure to gold. How you go about it is you need a demat account, just like you buy and sell shares through a broker. You can buy and sell units of gold ETF through your demat account. And if you are not, you're not interested in having a demat account, there's always the mutual fund route, because we have these gold mutual funds that invest in the gold ETF on your behalf. So you can, in a more simple and convenient way, kind of opt for that.
And a hassle-free way. Somebody else is doing the investing for you through the mutual fund.
Yes, there's no timing of gold prices or markets there, and as well as it gives you the option of, systematic investments because of the SIP route, which is a good way to, actually approach gold, because it's a strategic asset. You want to stagger and buy, the asset class instead of just running behind it when prices are, running up.
Absolutely. Absolutely. That's very helpful, actually. And it's always good to revise these these classics, right? I mean, everyone wants to have a little bit of exposure in some of these asset classes, but a lot of our viewers, a lot of young investors don't know how to approach it. So thank you for that. Let's do one thing. Let's take a short commercial break, but don't go anywhere. When we come back, we'll continue to talk about this rush into gold ETFs and how you can have it as a part of your portfolio and what the best approach is. Stay tuned.